is everything. I believe that for every ounce of gold and silver you own today, you are going to be able to buy many, many times more stocks, bonds, real estate, businesses, and just about anything else you want or need. One day, the precious metals are going to amaze everyone. Make sure you come back and read this chapter once gold goes soaring past $3,000, $5,000, $10,000 per ounce and never looks back, because the great gold and silver rush of the 21st century is absolutely going to take your breath.
Mike Maloney, a renowned precious metals expert, author, and creator of the acclaimed Hidden Secrets of Money series, has built his reputation on understanding the intricate relationship between monetary policy and precious metals markets. His expertise comes at a particularly relevant time, as gold currently trades in a directionless pattern below the $3,400 mark, with traders hesitant to make significant moves while awaiting clearer signals about the Federal Reserve's future rate cut trajectory. In this uncertain market environment, Maloney presents a compelling long-term thesis that extends far beyond conventional wealth preservation strategies. He argues that gold and silver won't merely safeguard purchasing power, but will dramatically enhance it, positioning investors to acquire substantially more assets in the years ahead. His confidence in this prediction runs so deep that he urges readers to recall his words when gold reaches key psychological milestones of $3,000, $5,000, or even $10,000 per ounce, boldly describing the anticipated surge as the gold and silver rush of the 21st century. The foundation for such optimistic projections rests on several compelling and interconnected market dynamics that Maloney believes are already in motion. Central bank gold accumulation, combined with escalating global trade tensions, creates a fundamental shift in demand patterns that he expects will propel gold prices toward $5,000 an ounce by 2028. This institutional buying represents a sea change from previous decades, when central banks were net sellers of their gold reserves. More fundamentally, Maloney points to the growing disparity between expanding global money supplies and the finite nature of gold reserves as the primary driver of future price appreciation. This structural imbalance creates powerful upside momentum that traditional market analysis often overlooks. The mathematical relationship between currency creation and limited gold supply, supported by rigorous quantitative analysis, makes Maloney's seemingly audacious long-term target of $10,000 per ounce appear not only achievable, but economically reasonable. Before we begin, make sure to subscribe, hit the bell icon, and share this video. Your support helps us keep delivering valuable insights.
So now let's add it all up and try to estimate just how much currency could come chasing gold and silver in the great gold and silver rush of the 21st century. Versus 1980, today we have 18 times more people around the world that can buy precious metals, 55 times more currency, 56 times more millionaires, 200 times more billionaires, 220 times more available consumer credit, 31.5 times more assets under management, and 49 times greater global stock market capitalization. It's actually impossible to add all of this up. It really doesn't matter if there's 18 times more people who can buy gold and silver. What matters is how many people will buy gold and silver. It really doesn't matter that there's 55 times more currency in the world. What matters is that almost all of the newly created currency went to people who were already well off, people who have significant assets to protect and therefore have an investor's mindset. These are the people who will seek the safety of gold and silver in the next crisis, driving their prices to unimaginable heights. Now, as I said before, I don't want to double count anything or anyone here. So, to make this easy, I'm just going to lump currency, credit, assets under management, millionaires, billionaires, people with an investor's mindset, and the people with significant assets to protect all together and just pick a number the best I can. Let's say there's probably 50 times more currency available today for investment in gold than in 1980. Yet the amount of available gold in the world has only about doubled, so that's 25 times more currency per ounce. Then to that 25 times more currency per ounce, we must add the speed of light news and market dynamics, and that gold and silver are giffen goods that create more demand as the price rises, and the fact that their price responds positively to war, geopolitical crisis, economic crisis, and just about anything else that causes human anxiety, and you can still only get a tiny little inkling of just how big this thing is going to be. If the bull market of the 70s drove gold up 25 times and silver up 41 times, with only 1/25th the amount of currency per ounce chasing them, and then you add fear to the mix, just what do you think will happen this time around? I'm not cold-hearted. Yes, I'm concerned for the plight of the average worker, the average citizen, and the average investor in the crisis I see coming. They are the ones that are going to end up taking the punishment for our immoral monetary system. I'm sorry for them, and I'm trying to help. That's why I wrote this book. But please, somebody pinch me because I must be dreaming. I mean, I'm a precious metals investor, and this is just too good to be true, isn't it? I've gone over this hundreds of times, and I keep coming to the same conclusion. No, it's not too good to be true. It's exactly true, or even better. Enormity squared, indeed. But remember, price means nothing. Value is everything. I believe that for every ounce of gold and silver you own today, you are going to be able to buy many, many times more stocks, bonds, real estate, businesses, and just about anything else you want or need. One day, the precious metals are going to amaze everyone. Make sure you come back and read this chapter once gold goes soaring past $3,000, $5,000, $10,000 per ounce and never looks back, because the great gold and silver rush of the 21st century is absolutely going to take your breath away.
Maloney's confidence in these extraordinary price targets stems from the 1970s gold bull market transformation. In 1971, predictions of gold reaching $50 or $100 per ounce seemed absurd to most observers. However, the following decade proved these absurd forecasts conservative. Gold broke through $200 in late 1978, marking a shift as institutions began investing in bullion. Starting 1978 at $69.50, gold reached $245.25 by October 30th, driven by inflation and economic uncertainty. The momentum accelerated in 1979, with Time magazine covering panic buying and global gold rush. Gold hit $315 by September, then surged to $426 within a month, a 35% jump driven by economic fear. This was part of gold's climb from $35 to $850 between 1971 and 1980, a 25-fold increase fueled by oil crises, inflation, and global conflicts. As traders await Federal Reserve signals, Maloney's historical perspective suggests today's consolidation below $3,400 may offer positioning opportunities before what he anticipates will be a significant wealth transfer. Let's get back to the video.
The first chart was the S&P 500 index adjusted for inflation, but the second chart is not a chart of the stock market, it's a chart of gold. The reason it doesn't look like a chart of gold is because I've inverted it. I flipped it upside down. Here's the same chart of gold viewed right side up. That big fear-driven spike that starts on December 3rd, 1979, when gold surpassed its all-time high of $426 per ounce set the previous October, hitting $428 an ounce. That was the day gold took on the characteristics of a Giffen good. Although some people were feeling greed and just chasing the price, you must remember that the U.S. dollar had only been a fiat currency for a little more than 8 years, and many people were concerned that the U.S. dollar could actually fail. Their fear and panic caused gold to soar from $428 on December 3rd to more than $873 per ounce over the next 29 trading days, peaking on January 21st, 1980. To give you an idea of the emotion and psychology that was driving the gold price in 1979-1980, I've included an excerpt from an early draft of my first book. So what I'm going to read you next, I wrote probably in 2006, and then 50% or 70% of it was edited out of my first book. So this is basically the original draft. Gold had started rising from $35 an ounce almost immediately after leaving the dollar. But in 1971, anyone who said gold could reach $50 an ounce was considered crazy, and anyone who said that $100 per ounce was possible was tied up, hauled away, and placed in a rubber room. But in late 1978, gold broke through the $200 barrier, and something changed in the character of how gold was being traded and how gold was viewed by the public. Gold was once again acting like money. In God We Trust, Time Magazine, June 11th, 1979. In the past 2 years, a new brand of buyer has flocked to the market, American institutional investors. Some U.S. pension funds, mutual funds, and bank trust departments are putting a portion of their assets into bullion. In 1979, people started lining up in front of coin shops, and the phones were ringing off the hook at the commodities exchanges. The Glitter That Is Gold, Time Magazine, October 1st, 1979. From Zurich to Chicago, from London to Hong Kong, gold bugs are scurrying once again to buy into their favorite hedge against disaster. With people battered by inflation and recession, worried about oil, and lacking confidence in leaders and cures, the gold rush of '79 has turned into a stampede. In the past month, silver has risen 65%, while gold has gone up 23%. The popularity of such tangible assets reflects a fast deepening distrust of all paper currencies. Essentially, the price of gold is an index of anxiety and a barometer of fears. Gold had begun September of 1979 at $315, and by October 2nd, the day after this article, it hit $426, a 35% rise in 1 month. Gold languished for the next 2 months, but then on December 3rd, gold surpassed its previous high and it was off to the races. If the price continues to rise, or if there's a stock market crash or a problem in the economy or the currency, then a fear-driven panic can take over, causing more people to buy, which causes the price to rise more. This is the point where all of the sellers, the people who would normally sell and take profits because of the high prices, completely vanish from the market. They hold on to their gold more tightly because of their own fear, causing supply shortages, which causes many more people to panic, so they buy a lot more, causing the price to skyrocket, and so on and so on.
Gold reflects more than just market value. It captures public sentiment, fear, and trust in the financial system. From its explosive rise in the 1970s to growing demand today, gold continues to act as a safe haven in times of uncertainty. As inflation, geopolitical risks, and distrust in paper currencies intensify, the role of gold is once again gaining momentum, pointing to a powerful and potentially historic surge ahead.
Do you think gold will break its previous highs in the coming years? Let us know in the comments. If you found this insight valuable, don't forget to like, share, and subscribe, and make sure to hit the bell icon so you never miss an update. Thanks for watching.